transfer expenses. From that we deduct transfer expenses, or these are also called as selling expenses. Transfer expenses or selling expenses means whenever you are selling any asset, from that, and while selling that asset, you incur some expenses. For example, if you are selling any land, so you need to pay some brokerage charges or some commission charges or some registration charges or some transfer expenses. So that will deduct from actual amount received. So whatever amount we receive after selling some asset, from that we deduct transfer expenses or selling expenses. And this we call it as net sales consideration. This we call it as net sales consideration. From this we deduct less indexed cost of acquisition. This I am talking about the long-term capital assets. Indexed cost of acquisition means at what price we have purchased that asset, that will be deducted. It is called indexed cost of acquisition. And the next one would be indexed cost of improvement. Next one would be indexed cost of improvement. So we have indexed cost of acquisition and indexed cost of improvement. If we deduct these two, we get income from long-term capital gain. Long-term capital gain. So first is sales consideration or sale value, means at what price we are selling that particular asset, that rate, minus less transfer expenses or selling expenses. If you deduct that, you'll get net sales consideration. You'll get net sales consideration. And from that, if you deduct indexed cost of acquisition and indexed cost of improvement, and the difference whatever we'll get, that we'll call it as income from long-term capital gain. That we call it as income from long-term capital gain. Now, similarly, we have income from short-term capital gain also. Income from short-term capital gain. Just look at here. Here we write sales consideration. And from this we deduct less selling expenses. First sales consideration. From that we deduct selling expenses. And from this, whatever we deduct, that we call it as net sales consideration. The difference, whatever we get, is net sales consideration. And from this, again, we deduct. This I'm talking about short-term capital gains. Okay. This here we write only cost of acquisition. Why? Because it's less than 36 months or less than 1 year. Cost of acquisition. And if you have any improvement, then it will be cost of improvement. And these two we deducted from the outer column. And the difference would be income from short-term capital gain. Income from short-term capital gain. So here we don't have any indexation. Income from short-term capital gain. So this is the format for short-term capital gain. Income from short-term capital gain, this is. Similarly, the same one we do even for the long-term capital gain also. Just look at here, this is long-term capital gain. Here, same it would be. Here we do, only we add is indexation. That is indexed cost. The extra thing we are adding is indexed cost of acquisition and indexed cost of improvement. And this will be income from long-term capital gain. This will be long-term capital gain. So these are the format for short-term. You can find, I think you can find the difference. What is the difference we could find here? So this is income from long-term capital gain. And this is income from short-term capital gain. This is how we do the format. Next. Now we will try to look at how these problems are solved. So if we do one or two problems, we'll try to understand very easily. Okay. Just look at here. From the following information, compute the capital gains for the assessment year, that is 23, 20, 24, 25. Then 24, 25 is the assessment period. 24, 25 is the assessment period. We have house 1 and house 2, and the date of purchase, the given cost of acquisition, cost of additional construction, fair market value of 1st April 2001, cost of additional construction in 2014 and 15, and sale proceeds of the property in 1819, and cost inflation index, the given the periods. And if you just look at here, this is how we doing selling price, the given, and there are no transfer expenses, so we are not deducting any transfer expenses. We are doing only indexation. And here, whenever you are doing the indexation and the fair market value is given as well, the cost of acquisition is given, whichever is higher, that will be taken as the for the calculation of cost of acquisition. And here the fair market value is less, so higher one is cost of acquisition 1,890,000 into index value. In that period they given 1920 index value means 1890 they have taken, but we need to go for the, so here a previous value is, a previous year is 1890 in this problem. So the two value divided by the year in which the asset is purchased, and the asset is purchased in 2001 and 2, and in 1 and 2 index value is 100. 1 and 2 index value is 100. Similarly, index cost of improvement. So they added some extra room or some extra construction is done. So here the rate of construction, the cost is 51,800. Previous year index value divided by the year in which the improvement has taken place. The improvement has taken place in 2014 and 15. And in 2014-15 index value is 240. So 14-15 index value is 240. So cost of improvement into in previous year index divided by index value of the year in which the improvement has taken place. Then we get the index cost of acquisition as well index cost of improvement also. And if you deduct this, you'll get income from long-term capital gains. Income from long-term capital gains. House 2 again we have Index cost of acquisition, same they have purchased. Again, index cost of acquisition or index cost of improvement. If you look at for the index cost of acquisition of house 2, just look at here. Cost of acquisition of house 2 is 2,50,000 and improve fair value is 3,50,000. Out of the highest one is fair market value. So the fair market value into previous year index value divided by, it was purchased in 2001. So in previous year, purchase year is 2,100 rupees, that is 100 index value. Similarly, with respect to the index cost of improvement, here the cost of improvement 77,700 into index value, previous year index value is 280. That is as per that assessment year I'm talking. Here the assessment year is 1920. So your index value is, previous year index is 280. And the year in which the improvement is done is 2014-15 and 2014-15 index value is 240. When you calculate all this together, we get cost of improvement. We get a cost, and the difference is income from long-term capital gain. Income from long-term capital gain. This is how income from capital gains is done. And for this even we have exemptions. Exemptions under section 50. We call it as exemptions. Exemptions. Under section 54. Exemptions under section 54. So we under this section 54 also, we have exemption 54, 54B, 54D, 54EC, 50, 54EC and 54F, 54G and 54GB. These are exemptions which comes under income from capital gain. These are the exemptions which comes under section 54 under capital gains. So what are these exemptions? Whenever you receive any income, after calculating the income from capital gain, whatever the income you are earning, that income is not taxable totally. That income is exempted as per the sections. So section 54 talks that if you are selling any of your residential house property, if you are selling any of your residential house property, and that whatever amount you receive from that house property, again you are reinvesting. Again, if you are reinvesting in the same type of or new residential house, or purchasing any under construction house property, in your case, whatever amount you are investing, the total amount you get exemption under section 54. You get exemption on section 54. Next is 54B. Capital gain arising transfer of agricultural land. Means if you are having any agricultural land and you are selling that agricultural land, and whatever the income you are getting out of that agriculture, again if you are reinvesting in the purchase of the any other agricultural land, in that case you will get an exemption. You will get exemption. Next, section 54D. Capital gain on compulsory acquisition and building. Capital gain on compulsory acquisition of land. So compulsory acquisition of land and building means whenever means you are not selling out of your own willing, but as per the law or as per the requirement of government, you have to sell your land or have to give back to the government or compulsory acquisition of land and building. In that case, after taking that, whatever gain you get out of that, again reinvesting in the purchase of any other new land and building, in that case, you'll get an exemption. Next is 54 AC, capital gain arising from transfer of a long-term capital asset invested in long-term specified assets. Means what? Whenever you are selling any long-term capital assets, and whatever the amount you are getting, again you are reinvesting in long-term specified assets like National Bank of Agriculture and Rural Development, or by the National Highway Authority of India, or Rural Electrification Corporation Limited, or National Housing Bank, or the Small Industry Development. If you are investing in these assets, then you get an exemption. Next is capital gain not to be. So if you look at here, whenever you are selling or you are getting any gain and you are investing in specified units like any like startup action plan or any other related to specific funds, in that case also you'll get an exemption. Next is exemption from tax on long-term capital gains on investments in the construction of residential house. Means whatever the gain you received, but you are investing for what purpose? For any residential house, you'll get an exemption. Next, a capital gain exemption of capital gains on transfer of assets in cases of shifting of industrial undertaking from urban area. Means if you are shifting your resident industrial or whatever the gain you have received, for the purpose, for what purpose it is, for shifting of your industrial undertaking, shifting to urban to non-urban area, in that case you'll get an exemption. Similarly, if you're shifting to the special economic zones, that also you get an exemption. So this is about income from capital gains. Next, we discuss about income from other sources. The next one is income from other sources. This is the last rate of income from all the five sources. As we have discussed, the first source is income from salary. The next one is income from house property. The third one was income from business and profession. And the fourth one is income from capital gains. And the last one is income from other sources. Means the income which does not fall under any of these four sources, that will fall under income from other sources. So here, which will not come under salary, which will not come under house property, which will not come under business or profession, which will not come under capital gain, that will come under income from other sources. Like if you receive any income like pension, widow pension or family pension, or income from crosswords, puzzles, or card games, or gambling, car races, horse races, that all incomes comes under income from other sources. If you just look at here, we have specific incomes as well as general income. Specific incomes means interest on securities, dividends, winnings from lotteries, crossword puzzles, races, card games, bettings, other games, and income from letting of plant, machinery, or furniture, which are not taxable under business incomes. Next, we have general incomes. Any fees or commission received by an employee from a person other than his employer, director's fees, income of royalty, rent of land not appertaining to any building. So these all are general incomes. So especially we talk about the interest on securities. Here securities means it may be any debt or any loan or any paper or any debenture or any bond or any security or certificate. Here types of securities. We have three types of security. That is service securities exempt from tax, tax-free securities and less tax. Under securities, again we have securities which are exempt from tax, which are exempt. Like if you can just look at here, we have around 24 securities. If you do any investments and from this if you receive any income, that is taxable under income from other sources, that is national defense bonds, special bearer bonds, treasury saving deposit certificates, post office cash certificates, national plan certificates, fixed deposits. This all comes under security exempt from tax. Next is tax free securities. Under tax free securities, again we have government as well as commercial. So under commercial we have listed in stock exchange and unlisted in stock exchange. Even less tax securities also we have government as well as commercial. Under commercial again we have listed in stock exchange, the other one is unlisted. And even income derived from letting, family pension, winning from lotteries, puzzles, family pension, named incomes. So this is income from other sources. So this all comes under the block 1. Now we have block 2. And even block 1 we have aggregation of income, that is set off and carry forward losses. So the next one is aggregation of income, set off and carry forward of losses. So here we aggregate the income of other persons included in the assessee's total income. So here we include the income of other people in the income of the assessee itself. That may be means transfer of income without any transfer of assets shall be. Means we transfer only income, but we are not transferring to whomever we have transferred. But still, whatever the income we receive, that is taxable in the hands of ourselves only. Income of spouse, income of daughter-in-law, transfer of assets to other persons or association of persons for the benefit of spouse, income from assets transferred to a person or association of persons for the benefit of his son's wife, income from business, income of a minor child, cross transfers, transfer of separate individual property or self-acquired property to Hindu undivided family of which is a member or conversion of property. Next, we have aggregation of incomes. So here we aggregate cash credits, unexplained investments, unexplained money, amount of investments, unexplained expenditure, amount borrowed or repaid on hundi. Next is set off of losses. So here, for example, we are even doing the income from, we have income from business. So what are the loss we are incurring? How to write off that loss? That is set off under the same head. If you are getting any loss from speculation business, you should set off that loss from the profit of the speculation business only. Then only it is considered. If you are setting it out of the any other heads, that is not permitted. Next is set off against income under other heads. So here, after setting off a loss under the same head, still there is some loss. In that case, that loss can be set off against income of the other head also. Next is speculation loss. So any losses are occurring because of business that can be set off uh, profit and gains. Loss from the activity of owning and maintaining resources. Any losses that arise from the act of owning and maintaining race or horse races can be set off against profits from the owning and maintaining of horse race only, not against any other incomes. Next, loss from business or profession. You can get any loss from business or profession that can be set off from other income that is tailing under the same head only. It cannot be right off against any other heads. It's capital losses. We have short-term capital loss and long-term capital loss. And losses of lottery, crossword puzzles, gambling, card games, or betting, etc. Loss of association of persons or body of individuals. Carry forward and set off of losses. Carry forward and set off of house property, carry forward and set off of business, and also carry forward set off of speculation, owning, maintaining resources, compiling of loss returns. Next is law, where we talk about computation of total income. So what is the section that comes under computation of total income? There we talk about section AG, or called as chapter 6 deductions. Deductions under chapter 6, where we talk about sections from 80A to 80G. 80A to 80G. So the deductions which we discuss here are whatever the income is saving to do, these are all deductions. Before going to gross total income, you should know what the deductions that are available to that particular entity. ATC talk about the gross qualifying amount. Here, if you invest any amount in life premium or we have of deductions which are allowed under ATC. Under ATC, contribution to pension fund, contribution pension scheme of central government employees, medical insurance, 80 talks about medical insurance, medical treatment in specified disease, repayment of taken for higher education, donations to certain funds or investments, deduction for scientific research or rural development, contribution given by companies, political party, profits engaged from industrial enterprises, engaged in infrastructure development, profits and gains from certain ATIC, profits and gains from certain undertakings or enterprises in the state profits and gains from business of collecting and processing of biodegradable waste, employment of new work and reductions in the rate of income of corporate, that is of to 80s, and the remaining will continue in the next class. Thank you all.